What if I told you there's a way to lower your taxes, grow your money tax-free, and then pay for all your healthcare expenses tax-free 30 years from now using today's dollars? Would you believe me? It's not a gimmick, it's called an HSA, or a health savings account. And it's easily one of the most underused tools in all of personal finance. Combine it with an FSA, and now you're stacking tax hacks that most people know nothing about. In this video, I'll walk you through the 2025 rules, who qualifies, and how to use these accounts to save thousands of dollars, whether you're just trying to reduce your tax bill today or building your wealth for the long haul. And before we dive in, my name's Ryan Knoll. I'm a certified financial planner and founder of Nav Wealth Partners, a financial planning firm that helps clients nationwide make smart money decisions. Let's jump into the video. So what's an HSA? We're going to start with the basics. An HSA, or health savings account, is a special savings account designed to help you pay for medical expenses with pre-tax dollars. But here's what makes it extra special. It is triple tax advantaged. You get a tax deduction when you contribute, which can save you thousands of dollars a year in taxes. Your money grows tax-free when it's invested, similar to how money grows inside of an IRA, and you can withdraw the money tax-free for qualified medical expenses. That's right, no other account gives you all three, not a 401k, not a traditional IRA, not even a Roth IRA. And get this, there's no time limit on when you can use the money. You can rack up medical receipts in your 20s and reimburse yourself decades later in your 60s and 70s. As long as you keep those receipts, the reimbursement is 100% tax-free. So how do you get one? To qualify for an HSA in 2025, you must be enrolled in a high deductible healthcare plan, or an HDHP. Here's what that means for this year. The minimum deductible in your healthcare plan must be at least $1,650 for individuals or $3,300 for families. The maximum out-of-pocket expenses an individual can incur for the year is $8,300 or $16,600 for somebody who's married. If your plan meets those criteria, you're HSA eligible. But there are a few other rules too. You can't be enrolled in Medicare, you can't be claimed as a dependent on someone else's tax return, and you can't have other healthcare coverage unless it's limited coverage like dental or vision only. Okay, so let's talk numbers. In 2025, here's how much you can contribute. For individuals, you can contribute $4,300 into your HSA. For someone who is on a family plan, whether you're married or single with kids, and your kids are part of your healthcare plan coverage, you can contribute $8,550. And if you're over the age of 55, you can do an additional $1,000 a year as a catch-up contribution. And these contributions can come from you, your employer, or someone in your family. Just remember that all contributions combined count toward the annual limit. So if your employer will put $2,000 a year into your HSA and you're a single HSA participant, you can only put in $2,300 of tax deferral money from your paychecks before you max out that plan, assuming you're under the age of 55. Also, contributions can be made all the way up until April 15th of 2026, similar to how it works with an IRA and a prior year contribution. Now let's talk about the strategy to actually maximize this account, because what I find is a lot of people don't use this account to its full potential. So here's the playbook. First and foremost, you want to maximize your account each and every year. This provides current tax savings and gives you a good base of funds to invest with. Next is you don't want to spend it just yet. And this is the big mistake. A lot of people use their HSA debit card for every doctor's visit or every over-the-counter prescription that they buy. You don't want to do that. Save those receipts. We're going to pay for them later on. The next step is to invest your HSA funds. You want to make sure you have enough cash set aside in the account to cover your deductible for the year. So if you have a $3,000 deductible, you want to save $3,000 just as cash in that account, never to be touched so it will cover your deductible limit. But anything beyond that deductible amount, you want to invest. And you want to invest rather aggressively, especially if you're young, because we have a lot of time for this money to grow. The fourth step is you want to track your receipts. So find a system that works for you. But the idea here is you want to record the date, the amount, the provider, and make a copy of every healthcare receipt that you have, because we're going to use those later on to pay for those healthcare expenses out of your HSA once that money's had a chance to grow. Fifth, this is when the reimbursement happens. So whether it's 5 years, 10 years, 30 years from now, you can withdraw money from that HSA tax-free thanks to those receipts. This helps your HSA function like a stealth retirement account. This is what I like to call the super Roth. One of the biggest advantages an HSA has is when it's utilized for long-term care expenses. Let's assume you're 30 years old right now and you plan to work until you're 60. You also plan to max out your HSA every year, and as a married individual, that means you can put in $8,550 every year. Let's assume you earn a pretty modest 8% rate of return on that account. By the time you are 60 and ready to retire, you would have nearly $1 million in your HSA. Now, the biggest expense you'll have in retirement is healthcare costs. And I'm not talking about the premiums you pay for Medicare, but rather out of pocket expenses you will have to pay in case anything goes wrong. And even more specifically, what you would have to pay if you were to incur a long term care event. Long term care events get very expensive very quickly. Today, they typically last 2 to 3 years and can cost between $120,000 to $180,000 annually. If you use an IRA to pay for this, by the time you take into consideration taxes and the expenses themselves, you will be lucky to have 20% of that $1 million IRA balance left over. And if you are a married couple, it is likely either you or your spouse will incur a long term care event based on current statistics. But if you use your HSA to pay for expenses, that money can be withdrawn tax-free, so you don't have that same tax drag as you would pulling from the IRA. And an even smarter move would be to use your HSA to pay for a portion or all of your premium for a long-term care insurance policy. There are limits, however, on how much you can use annually to pay for a premium on a policy for long-term care insurance, but typically somebody in their 60s can use about $5,000 to pay onto their premium for a long-term care insurance policy annually tax-free. This will give you even more long-term care coverage without having to derail your entire retirement plan. Now let's change gears a little bit and talk about an FSA. An FSA, or a flex spend account, is another pre-tax account you can use to pay for medical expenses, but it works a little bit differently than an HSA. First off, you don't need a high deductible health insurance plan. You can use it for dental, vision, prescriptions, even if you're not enrolled in any health insurance, but mostly it's a use it or lose it type of account. Historically, if you didn't use the money by the end of the year, it just disappeared. But under current rules, your employer can let you roll over up to $640 into the subsequent year, or give you a grace period of 2.5 months to use any unused funds in the following year. Just something to be cognizant of if your employer offers an FSA and not an HSA. While it still gives you some of the same benefits, it's much less flexible and much less of a long-term tool than its counterpart. So the question I often get from savvy investors is, can I use both an HSA and an FSA? And the answer to this question is kind of. If your employer offers it, you can pair an HSA with something called a limited purpose FSA. This FSA can only be used for dental or vision expenses, not general medical expenses. That way you get the best of both worlds up to a certain point. You'd want to use your limited FSA for dentist and optometrist visits, so you can pay for things like your contact lens prescription or your dental cleanings, but you want to save your HSA for the long-term growth strategy. It's a rare combo, but if you'd have access to it, it is a smart move because it gives you the upfront tax savings using both the FSA and HSA, but the long-term growth and long-term advantages of holding money in an HSA for a long period of time. So what exactly can you spend these accounts on? Here's a few of the bigger ticket items that I typically see clients using their HSA and FSA to spend for. Doctor's visits, prescriptions, dental and vision costs, so your contacts or your glasses, mental health or therapy, physical therapy, lab work, x-rays, vaccines, and medical devices. But it doesn't just stop there. Over-the-counter meds, first aid kits, eye drops, and even electric toothbrushes and hydration packets could be HSA eligible. Amazon actually has a section where you can filter for HSA and FSA eligible products, and it's very useful. So here's where an HSA becomes even more powerful. Once you turn 65, you can use your HSA for anything. You want to buy a new car? You can use your HSA. You want to take a trip? You can use your HSA. You want to buy a second house? You can use your HSA. Just be cognizant, though, that you will pay ordinary income tax on those distributions because you're not using them for qualified medical expenses. But if you're over 65 and you are using them for qualified medical expenses, these are still tax-free distributions. You can also use them to pay for things like Medicare premiums, long-term care insurance premiums, or medical expenses your other accounts can't cover. And there's no required minimum distributions, which gives you extra flexibility in retirement. So if you've amassed a big balance and you don't think you're ever going to be able to deplete that balance during your lifetime due to healthcare costs, you can use this account to supplement your retirement lifestyle. So let's recap. The HSA is the most tax advantage account in the United States, and it rolls over forever. The FSA is a bit more limited, but with careful planning, it's still great for covering everyday medical costs. And if you're eligible for both, use them strategically and keep track of your receipts. And above all else, don't leave free money on the table. If you found this video helpful, drop a comment below, give this video a like, or subscribe to the channel. You'll get more weekly videos just like this one. And if you're wondering how an HSA or an FSA can fit into your financial picture, Follow the link in the description to book a consultation directly on my calendar. Thank you again so much for watching. Can't wait to see you in the next video.